So the awesome part of this is even if you aren't actively involved in real estate, if you don't own your home or aren't investing, we all know somebody that is. And so this is information that you can take back to your friends and family. And that's a big part of what we believe at Red Branch is this is the largest investment that you'll ever make in your life, whether it's your primary residence or a rental property. Oh, there you go. Thanks. Thank you, Catherine. So I am Ashley Gentry with Red Branch Realty. We also just opened a commercial division right before all of this started. So Red Branch Commercial as well. I've got Susanna McReynolds that has joined us. She is my right hand, keeps things moving and grooving. She's also a licensed realtor. And then Ike Mutabana, he is our commercial investment consultant, and he and I have done work together in collaborations for a couple years now. So he's come on board and is actually my business partner in the commercial company. So we're super excited, and just wanted to share a little bit of information that you guys can take back with you. Like I said, education is the biggest thing. Ike and I decided to form the commercial company out of the need that there wasn't a consumer-driven commercial approach. You know, you can have that personal approach in residential. It's super easy because you're walking. This is somebody's home that you're trying to find, but and the investment side and commercial side, I think it gets a little sterile, and investors need to have a personal approach as well. So we combined our powers, and that's what we're going to talk just a little bit about today towards the end. But please ask questions. You can use the chat feature if you would like, or unmute yourself, and we can go from there, because if you have the question, somebody might else as well. So COVID-19 and real estate, that is, I guess, all of our topics right now. So, and I apologize, I am actually presenting on my laptop because I wanted to be able to see everybody's faces at the same time, so I'm not straying away my attention. Great thing, things that people are asking, and obviously these, until we have more information, we've got to go off of data. And the great part is Texas is projected to be one of the least impacted. We're all going to be impacted. We're already impacted by COVID-19. But we, Adam Data Analysis, did a study last week, actually, that Texas has 10 of the 50 least vulnerable counties from among the 483 that they actually researched in this report. 3 of those being Dallas, Collin, and Tarrant counties. So that's basically the meat of North Texas. So that's super encouraging. Again, whether you're a homeowner or an investor, those things we need to continue to keep in the back of our mind. We're all going to see an impact, but to hear that we've got 3 of the least vulnerable counties is fantastic. So why DFW is faring better than others? Our unprecedented job growth over the past several years. We've been super blessed with that. The affordability factor, while people don't think it's as affordable as it was, of course it's not. We are still one of the most affordable metropolitan areas in the country. So that makes us considerably desirable for corporations to move their headquarters, and people can still have a great quality of life here. Interest rates, that's kind of on a broad scope. Everybody gets to benefit from that, but interest rates are still at a historical low. We actually think they'll probably get a little bit better here in the next month or two after we see a little bit more information about COVID-19 and what that's going to do on the mortgage side. So mortgage forbearance, that's where we're going to find out whether or not the interest rates are going to go down or up. So there's a reason for it. And it's out there, and people should utilize it if they need to. But we are already seeing some situations where it's negatively impacting people. And so I go back to, and this is where especially take the information back to your friends and family, because there's mortgage forbearance. There's also auto loan forbearance. They're offering those as well. And here's the deal. There's different types of qualifications for those forbearance programs. They want to obviously see if you truly need it. So if you take it and they accept it towards the end of the forbearance, you might actually have to give a full balloon payment of the mortgage or loan payments on your car that you actually deferred. So people have been talking about there's other ways they're going to do that. They might spread it out over a 12-month period, put it on the back end of your mortgage or your loan, but that's not a guarantee. You're going to have to qualify for those things. The other thing about that is, though, there was a lender that's in my network that actually gave a real life testimonial that's happening right now. There's a couple in Florida who already had their home for sale and was under contract. So they are under contract to purchase one, have stellar credit, make tons of money. But right now the mortgage companies are having you repull just about every 3 days to see if anything changes on your credit report. And the wife had co-signed for a small home loan for her mother, and the mom elected to go into mortgage forbearance. So when he pulled the credit report, there showed a loan in forbearance on there. So there is no amount of money that will actually get them to qualify on the loan. They are going to be homeless. Sellers do not have the right to terminate. So unless the buyer lets them out of the contract, they will have to move out of their home and into transitional housing until they can get that fixed. And we don't know what the long-term impacts are going to be, how long it's going to take you. So, so if you have the desire to sell your home and purchase another one when this is all said and done, or potentially refinance, don't do it unless you have to. And going back to, it's there for a reason. And if you have to, please use it. But just make sure this is something that you're not going to take a long-term hit on a short-term, creating more bandwidth in your budget. So I always go to, everybody always asks, no matter what's going on in the marketplace, is it a good time to buy? Well, Louis Glickman said it best, the best investment on earth is earth. And I bet the past few years, you wish you probably would have bought something else, even pre-2008, all of these other times, we have continued to appreciate as far as the home values go. So it's always a great time to buy real estate. It's always a great time to buy investment real estate. So that's something that we're seeing people. The rental market is still extremely robust right now, especially if people are having to downsize, unfortunately, because of what's going on. Maybe their businesses have shut down or they've had to decrease, and they want to create some additional bandwidth so they don't have to shut down permanently. I've got one that's on the market right now in Rockwall because he was not deemed an essential business in Dallas, and so had to lay off 85% of his employees. Now he retooled his equipment. He's actually a photo lab and they've been in business for decades, but he retooled all of his equipment to make medical face shields. So he is now deemed essential again, has been able to bring on some more of his staff, but this is just a holding pattern. So in between, he said, you know what, let's dump it. Let's get out of here. He's also got a rental property that's going to give him increased income during this time. But those are things that we're all dealing with right now. So as far as, is it a good time to buy? Is it a good time to sell? Yeah, it still is. With interest rates at a historical low, it's still going. And in fact, I have a showing on that property this morning. We have a sanitation station with gloves and footwear and a trash can as you exit the door. We also have hand sanitizer there. We ask our sellers right now to keep doors ajar, lights on, different things like that, just to reduce what somebody will have to touch in the home. So we can still actively sell your home. We've got virtual tours that allow people to view the homes beforehand. So there are things we can do. A lot of people don't think real estate is an essential business right now, but it absolutely is. So whether you need to downsize, whether you were in interim housing or your lease is ending or anything else like that, we can still actively do these things. So going forward, the other thing that people keep on asking about is, do you still need to protest your property taxes? During COVID-19, most of the appraisal districts are not equipped, as some of you probably know, to handle different volume or online volume. So they're working really hard to try to figure out what they can do to still facilitate this. But the short answer is no. The short answer is until they figure this out, there's nothing you need to do right now. Your appraisal district will get in touch with you and let you know how they intend to operate virtually for now, but they will give you plenty of time to do that. So that's something great to reach out to your trusted realtor if you already have a relationship. If not, I'm happy to do a comparative market analysis on your property taxes when it comes time, but don't stress that. And I think we're going to see a lot more infrastructure come around this that might make it easier to protest your taxes long term. So that being said, we're going to go into the commercial side real quick, and Ike's going to present on that just a little bit. But does anybody have questions or have heard information that they're not sure is true or not? I'm happy to answer if I know. Like I said down there, ask away. If I don't know the answer, I'm sure I know somebody that does.
Hey, Ashley, for someone that's never invested in real estate outside of their personal residence,
Sure.
what is your best advice on how to even get started with that?
Sure.
Should someone have the funds to play with?
Absolutely. So again, the lending landscape is going to change a little bit going forward, probably more for the short term. But in traditional sense, most lenders will require a 25% down payment for a second home, investment property, something of that nature. As you start investing into larger multifamily situations, something larger than a quadplex or 4 units, or commercial properties, that's going to change just a little bit. But if you're just looking to maybe start a rental portfolio and acquire, your first rental property, you need to have about 25% as your down payment. The rest of the costs are very similar to purchasing a home as far as inspections and earnest money and different things like that. So it's not a difficult process. It's not overly cumbersome, but it does require a larger down payment than if you were going to traditionally buy a single family. A single family, we've got programs as low as 0% for rural areas. But the average down payment side is probably closer to 5% for most people. We do see people do 20% down on their personal properties, but there's really no variance on that on the commercial side. So you do need a little more liquidity and capital. Yeah, so that's it on there. Anything else on forbearance or Ike or Susanna? Is there anything that you guys have heard that maybe we need to throw out there on the residential side that I didn't touch on?
Yeah, I don't think there is specifically residential related, but I think what you said actually made a lot of sense. And that's something I've been seeing over the past several weeks, right? That the forbearance programs are there for a reason. If you really, really need it, absolutely you should take advantage of it. Versus what happened in 2008, where that did not exist, right? A lot of people went under when they could really have survived if the banking and the lending market had been a little bit more flexible. So that flexibility exists. That said, my conversations have obviously been more with the commercial lenders, and I think the suggestions they've made are very applicable on both sides, and they sort of reflect what you said about the residential side, which is that while that forbearance is available, it's not going to be free. There's no free lunch.
Right.
Just let's be honest about it, right? At some point, in some manner, that is going to come back to affect you. So if you absolutely feel that that is what you need to do in order to stay afloat, in order to make sure that you can ride out this crisis, that makes perfect sense. But if you're doing it because you think it's there and you have other means to stay afloat, then you might be doing yourself a disservice potentially by taking advantage of a program that could come back in the long term to hurt you in some other way, right? Because especially on the commercial side, a lot of these loans are either through mortgage-backed securities or they are through these Freddie Mac and Fannie Mae agency-backed systems. And there is a collaborative effort generally for most loan providers to see the history of a creditor. So it doesn't matter what period you took it in and what was going on. When it stays in your history, it's like insurance, right? You use your insurance. I mean, I'll give you a great example. I had a problem with flooding and I just called to find out if my insurance covers it. I didn't even put in a claim. It went on the record that I called to find that out.
Yeah.
So that kind of thing is really problematic. So I would say really make sure you talk to your mortgage broker, your consultants, whoever it is that you work on the financial side, and really be very, very clear on the steps you need to take.
Yeah, because that's it's for deferring these payments right now might not be the smartest, but I mean, there's other things that you can do. I just did it myself. We was going to have to put about $3,000 into our Highlander, tires, brakes, windshield, all of these other things. And there were great programs going on. So I actually leased a brand new vehicle. And through there, they're just offering, and that's normal, offering 3 months deferred. So it wasn't, I didn't go into the program. It was just something that was already there. So do that. I mean, that created more liquidity by me not having to shell out $3,000, and I don't have to make my first payment for 3 months. So I really probably put closer to $5,000 back into my bank account during this time. So there's smart ways to do it. There's also, they're doing no penalty withdrawals on some retirement accounts. And again, there's always stipulations. So you need to make sure that you consult your CPA or your financial partner. But those are the type of things that I want to see people do so they don't limit their opportunities in the future. As long as there's no penalties on things like that, that's where we can get smart and create a little more money in your budget, because we all need to figure that out right now. So, but that's, we couldn't stress that enough. I don't want to sound insensitive by saying don't do it, but just really make sure that that's the only option for you guys going forward. So we're going to springboard into the investment side. It's really quick. So we won't keep you guys longer than necessary, but we just want to educate you so that when these talking points come up or conversations come up with friends or family, that you're able to give them true, realistic expectations and information. So the impact on commercial real estate, I'm going to let Ike touch on that. He and I have been trading off on webinars and speakers and just trying to keep our ear to the ground as to what's really happening instead of being reactionary with the information we share. So go ahead, Ike.
Yeah, absolutely. Thanks, Ashley. So, this is actually really good segue into this, and especially the first part of this, which is multifamily. So, one thing that has become absolutely clear in this kind of a crisis is that while almost every aspect of business across the economy have been affected, right? And real estate as well. One of the areas which clearly shows a lot of resilience, and it's historically been known it has, but it's showing even more resilience now, is just residential real estate, which is both single family on the residential side, multifamily on the commercial side. And there's a very simple reason for it, right? A roof over your head is an absolute essential. You can work from home. You can do things remotely. You can do drive-throughs and all kinds of stuff. End of the day, you need a place where you're going to live, where you're going to actually, sleep, where you're going to work from home is a home. So one way or the other, whether it's single family or multifamily on the commercial side, doesn't matter. That is clearly showing its resilience in this environment. That said, doesn't mean that it's not affected. So there's probably a similar effect on both residential and multifamily. The impact of the effect is potentially a little different depending on the scale, location, and those kind of things. Obviously, rent collections are a problem right now. They're a challenge because people are losing their jobs. People are making less income. A lot of the multifamily that is not class A luxury style, but is more ordinary middle class or workforce kind of housing, those are directly impacted right now because a lot of those people are contract workers. They work part-time jobs. Their hours have been reduced. So rent collections are clearly a challenge at the moment. That said, it's one of those things where as long as you can write it out and you've got the structures in place to survive that, it is something that will come back. And the other part of that is leasing activity, right? I mean, if you're in a single family space where you've got a tenant for a year or 2 years or whatever it is, you're okay. But if you're in a multifamily space where, let's say, you're dependent on short-term leases, well, that area is a little bit affected more than others. The long-term lease ones are generally okay. This is a time where people who might be considering not renewing their lease are actually renewing it because they really would rather stay with the devil they know versus trying to go somewhere else. So it's a mixed bag. Um, there's one aspect of this which is evident in Texas a little bit more than other states, is the fact that, and this, and trust me, again, trying not to be insensitive, but the evictions moratorium that has been put in place by the governor and by most counties as well, it's a very humane response for sure. The problem is that it creates an imbalance in the equation between the tenant and the management, right? Where now there is a clear guideline on what you cannot do with residents who are not able to pay, which I completely agree with, by the way. But on the other hand, there is absolutely nothing that is being done to help the management to actually manage the cost of maintaining those residences while they cannot have any recourse. So, I think that's a tough position to be in. I fully expect that to clear out at some point, that imbalance. The good thing is some of the government aid that has come in through the CARES Act, right? The Paycheck Protection Program, the Economic Injury Disaster Loan, if I'm remembering my acronyms correctly. These things will help cushion the blow a little bit, but there are some difficulties even in that to qualify that make it a little tough. Again, that said, I'm not trying to be doom and gloom here. It's just a reality. This is where things are. It's a matter of a few months. Hopefully, if it's a few months that it takes to really clear up all of the difficulties in the economy and get back into some semblance of a normal state. The other part of multifamily and potentially for all commercial real estate is the debt markets are uncertain, right? So in single family, you still find lenders are able to be a little bit more, optimistic just because of the fact that dealing with smaller asset sizes. On commercial, because the asset sizes are larger, the scale is larger, and there's a bigger fear factor in the market that causes the debt markets to be uncertain. And the agencies are not helped by putting out rules and regulations out of the blue that really throw a wrench into the cash analysis that most investors will make in figuring out how much cash they need to actually buy a commercial property. So that said, what are the areas of opportunities in multifamily, right? The areas of opportunity I would say are, this is similar to almost any recession situation where people who go into distress, apartments that are facing delinquency issues, vacancy issues. Those are the areas where I think there's a lot of opportunity now because we know, again, multifamily is going to come back up. It cannot go anywhere, right? Debt affected properties who took on too much debt. Those are the ones that are going to be a little bit of a trouble, especially if they go into forbearance. And then, as Ashley said, if they end up with a forbearance that requires a balloon payment, well, that's going to put a wrench in the works. So the other part that is an area of opportunity is workforce housing. I know workforce housing today sounds a little strange to say because that is the population that is really affected. But at the same time, that is also the population that has the highest need for affordable housing. And when I say affordable, I don't necessarily mean Section 8. I just mean of people who need houses that they can actually afford to live in, and which may not necessarily have the full market rate, but even below market rate can be really solidly cash flow positive. So, and don't depend on any kind of special value that you have to create in order to make it attractive. Those are the kind of workforce housing that are really useful. So areas of opportunities in everything we do, right? So think about office space, right? In office space, for example, we've got a real interesting situation with work from home now becoming prevalent everywhere. A lot of people now probably thinking that maybe I don't really need that expense of an office. So there's a little bit of a question mark over the long-term viability of offices retaining the same kind of attraction that they used to have. That said, again, there are areas of opportunities here, right? So I think your property at Jaeger is a great example of that, right? A co-working space that isn't putting the burden of a full office on you, but at the same time is providing you that really good customized service that makes you feel that you're part of a larger, community versus just being holed up in a four-wall kind of situation. So I have a feeling that co-working spaces are going to be doing much better than they were. They were already doing well, but they're going to become much more valuable because a lot of people. I mean, I'll give you an example of my CPA, right? My CPA has got a staff of like 7 people. He's now completely, remote. And I was talking to him last week, and he said, "No, I don't think I want to go back into my 2,000 square foot office anymore. I think I'm probably just going to get like 3 co-working spots somewhere and have my staff just go in when they need to." So I can see that that is really interesting shift that will probably happen. Another interesting area of office space that is going to become an area of opportunity, in my opinion, is medical offices. So medical offices are the one of the few businesses that have been deemed essential, and can remain open. Have actually tried to ensure that they can serve their patients and customers. And there's an opportunity here where potentially some types of office spaces might be retooled into medical offices and become a lot more valuable. There's one thing that has clearly shown up in this entire crisis is the lack of sufficient medical facilities across the US. And Texas, I think, is a little bit better off than most other states, just because I think there's been a lot more investment over the last 5 to 7 years with the economy growing. But I think there's a lot of room to expand on that end. The one area that I think has really been hit very badly, and I think has a huge question mark around it, is retail, right? Because anything that depends on foot traffic, right? Restaurants, fitness centers, your salons, your barber shops. I mean, anything that requires people to come in or walk by and see your store, every single one of those is impacted. And I think the problem is that for them to come back on their feet quickly enough is a real question mark, because a lot of restaurants are also looking at drive-through options. They're looking at pickup options. A lot of serving staff has lost their jobs, so that area is going to be a little bit difficult. On the other hand, within retail, things that are necessity related, right, things like grocery stores, right, those are going to thrive. Pharmacies are going to thrive. So I think one of the key areas that I think are important to look at when you think of retail as an investment space is, does that retail strip that you're looking to buy, does it have a good mix of necessity-based stores and foot traffic-based stores? If not, is there an opportunity to rebalance that somewhat so that you have that good mix? There was one retail strip that is that I was looking at. It had a toy store, it had a bakery shop, it had a fitness center, it had a laundry service, and it had, I think, a burger joint. All 5 had to shut down. So you can imagine where not only are each of those businesses hurting, but the owner and the manager of that retail strip is in dire straits, because every single one of his 5 tenants is asking for some kind of lease modification, some kind of rental change. It's not a pretty picture. So you don't want to be in a retail situation where you have that kind of skewed distribution. So I think that's another area of opportunity. Think about, either get into something that has good balance or create that balance as part of creating value, right? And then industrial is a really interesting thing. Industrial is somewhat like multifamily, because a lot of industrial spaces tend to be used for things that are the driving forces of the economy, right? They're either warehouses for distribution, they're manufacturing facilities, and that is where the opportunity exists. So they've all been hit just because of the fact that people cannot go in, and many of them have the kind of work that cannot be done from home. It has to be done in that industrial space. So on the other hand, Ashley's story of her client who was able to retool from a photo studio into manufacturing masks.
Yeah, face shields.
Yeah, all right. So that kind of pivoting, I think, is going to be really useful. Again, medical related stuff, healthcare related stuff shows its resilience here, because if an industrial space can be used for manufacturing in the healthcare sector, or it has spaces that can be used for that, or even warehouses that serve the e-commerce industry. E-commerce has been doing fantastically well in this environment. And it was already doing well, so it's probably going to now zoom up even more. That's the reason why Jeff Bezos, his, I think, net worth went up by $24 billion in the last 1 month, something insane like that. So I think that is one of the interesting areas in industrial. So it's an area of opportunity, something to think about. Um, and when Ashley and I look at commercial properties for our clients, these are the kind of factors we're trying to keep in mind as we go in and both try to do the best for our clients in terms of what is the highest potential to do them well in the long term, but in the short term, income wise as well.
And I just want to point out one thing, and that's, we've discussed the Jaeger model several times even before all this happened. And you guys have something that's so unique, because we were in other co-working space environment and it was so sterile. The management was very cold, and the environment was as well. And so when we came here, and I told you that, Catherine, I mean, it's been a home. And for me, being able to come here and still do that safely with how you guys have taken care of us, it's been a mental lifesaver as well, to be able to come here, still be intentional, and feel like I'm safe. And that's huge. And you guys do that on a daily basis already. But it's really been obvious during these times. And so, you guys have such a mixed tenant base. And I think, again, that's really important. So going into that medical office space environment, there are restrictions, obviously, from safety protocols and health-wise and everything else. But it'd be really interesting to see somebody go in there and do something that's maybe a little more scaled down. But sorry about that. See, I'm doing business. So that was my showing. So that's great. I might actually get an offer on that for my client. Yay! But we're really intrigued about creating a Jaeger model for almost the medical offices as well. Something that can be more communal, offsetting cost, but also creating an environment where not only the doctors and the medical staff, but the patients enjoy coming. That's probably why the therapists do so well in this building, because it's a warm environment when you walk in. It's not a sterile medical office where you dread going. So just a little side note there, but these are the things where you got to think out of the box. We were already thinking this way before COVID-19, but I mean, Ike and I have been talking daily about, okay, what does this look like? And how do you create more recession-proof business models on the commercial side going forward? And that means on your single family rentals, on your multifamily. The single family, we are in such a dire need of quality rentals. So instead of this slumlord situation or, lipstick on a pig, going in there and putting pride into your rental properties, whether they're apartments or condos or single family homes, that's really an area of opportunity for investors too, that might not want to get into true commercial, but want to have extra income streams. Just having a nice looking rental property will make it recession proof. So that was just my caveat there. I'm going to go into, we've got, I think this is the last slide, and Ike, I know we're kind of running short on time. So if you'll just give a couple of pointers as to what these subject lines are, and then we're available for more in-depth questions if any of this piques your interest after the fact. So I'll go back to you, Ike, on that one.
Yeah, no, absolutely. In fact, you're absolutely right, Ashley. We've been talking about this, discussing it, trying to really do this for the people we know. In fact, probably the only thing that has changed in COVID-19 is that me growing a beard, just because I've been lazy, and that's been a matter of dispute between my wife and my girls. My wife loves it, my children don't. So, but yeah, so just investment opportunities, right? The key thing that's going to be evident, and it's evident after almost every recession, and this is no different, is going to be cash is king. And there are two big aspects to this. One is that cash is going to be really important because the debt markets are going to be, a little bit more difficult, right? Just because it's not that they're going to stop or freeze completely, but they're going to be a lot more cautious. The opportunities to get debt of different creative types is going to reduce, as well as I mentioned, in commercial properties, including multifamily, some of the agency-backed lenders now have to abide by some really insane regulations around the amount of escrow money that has to be put in, and that can be mitigated by putting in more cash and getting favorable terms. So there's that aspect of why cash is going to be important. And the flip side of that is, however, that I don't think investors should feel pressured to come in with a lot of their own cash. There's an opportunity where we've done this multiple times, where a few investors can come together in a pool. It doesn't have to be, you just do it by yourself. Get together with friends and family. We've got investors in our pool of the people we know who are willing to partner up with other like-minded folks and come together and achieve something a little bit better in higher scale. So I think scale is going to be key, right? So there's always a lot of benefit whether you're going for lower scale or higher scale, but the higher up you go in scale, generally you tend to do better in terms of your overall returns and profit. And in terms of the profits and the ROI, I think one of the things to think about is that uh, over the last several years, we've seen a tendency of a lot of people to invest based on the possible appreciation value, right? People got driven by the fact that values were going up continuously. And I think that is still possible in some cases, but to a large extent, investment needs to be cash flow driven. It needs to be based on what kind of income you can actually create from that investment on a regular basis. And that's a lot more of a resilient type of investment versus an investment that may or may not. It's almost like throwing darts, just like the stock market to some extent. And in fact, talking about the stock market, that is one area where I'm seeing a lot of people hurting on their retirement accounts, right? I just met an investor last week who was actually planning for retirement in like 3 years, and now is probably going to push that out for another maybe decade or so, just because his retirement account is hammered. Now possibly they made some mistakes in their allocation in the stock market, but regardless, right now everything in the stock market has been completely topsy-turvy. Things have gone up and down. Even the rally that has happened over the last few days, I've been talking to Wall Street analysts that I know personally as friends, and they don't understand why the rally is happening. Because there's nothing on the economic indicators, there's nothing in the economy that indicates that things are just going to go hunky-dory back in a month, right? Doesn't mean that it will not get better, but the idea that stocks can dip this way and then again start going back this way, in a short period of time, makes no sense. So there's a little bit of a gamble going on there. Nobody's very sure of where that is coming from, which is where I've seen a lot of success with many of my investor clients on self-directed retirement accounts. So if that is something you're not familiar with, that is something to look into. It is an opportunity for you to take some of your retirement money, put it into a self-directed account where it is still has the same tax treatment as your traditional IRA or your 401ks are, but where you then get the opportunity to decide how to invest that money. And that gives you then the opportunity to invest in actual income producing real estate, right? Where, as Ashley said, the best investment on earth is the earth. So it gives you a chance to do that. You're not locked into the Fidelities and the Vanguards and the T. Rowe Price, where all you can do is invest in the funds that they have. But this gives you an opportunity to actually pick and choose the things that the IRS says is okay for you to be able to do. Of course, there are some regulations, and which is why you need a good custodian of that money. You cannot be your own custodian, but those are things that we can definitely help you in terms of giving you some recommendations of. Well, I wouldn't say recommendations, but we can probably point you to a few resources that have proven that they are able to provide you the vehicles where you can do that kind of self-directed investment. So that's one thing I would definitely recommend a lot of people to really study and look into. The other aspect of the retirement accounts is under the CARES Act, is that about $100,000 can be withdrawn penalty-free from your retirement account, as long as you either return it back in 3 years, or if you take it as a loan. Um, I'm not sure I know exactly the clauses of how it has to be returned. So caveat there, you should talk to a tax consultant about how it has to be done. But the reason I brought that up is because that gives an opportunity to use some of that money to invest in real estate and use the tax depreciation losses that you get on real estate to offset the tax burden of withdrawing that money. So there's a little bit of a strategy that some of our investors are looking into, which I think would be worth looking into as well. And then as far as tax saving opportunities are concerned, 1031 exchanges, I think that is going to be one of the key areas where a lot of investors are going to be able to really help move their taxes and defer them as much as possible. If you don't know what that is, it's simply basically an IRS mechanism by which when you sell a property, if you have capital gains on it, you can avoid paying taxes by moving that into another type of property that has a similar impact in terms of how it's structured. They call it like kind. It doesn't have to be multifamily to multifamily. It could be a commercial warehouse to multifamily. It could be a multifamily to self-storage. Doesn't matter. The goal is that it has to be real estate, and it has to be real estate that achieves similar objectives. So there's a lot of opportunity there to use 1031 exchanges to defer taxes. There's qualified opportunity zones, which really started picking up about a few months before COVID-19 hit, but which is an amazing opportunity that was created in the last tax reform act that was passed about a year and a half ago. And it creates these zones allocated by the taxing authorities of each state, where they say that if you were to buy property in this zone and you were to redevelop it or improve it dramatically, you get a complete write-off of your tax for 10 years. So there's a lot of different caveats to it, obviously, but it is probably one of the highest value tax saving opportunities that exist out there that really very few players are looking at. And then there is obviously, when you get into commercial real estate, you also have the opportunity of what is called as accelerated depreciation. So everybody knows you can depreciate an investment property over 27 and a half or 39 and a half years. But when you have accelerated depreciation, what it means is you can take a commercial property, you can have an engineering study done that breaks down all of its components into every small little bucket. So your electrical wiring, your furniture, your plumbing system, every single thing can be broken out. And then parts of that can be accelerated in depreciation in 5, 10, or 15 years. So if you had $100,000 worth of money within, say, $300,000 of property, and that $100,000 is classified as 5 or 10-year depreciation, you can imagine that you're depreciating, it almost 30% more than you would in a normal depreciation schedule, which is again a good offset for anything you might do that might incur more tax on some other part of your investment portfolio. So these are just some different ideas and things that you can do. Where commercial real estate is useful, investment strategies are useful, and we're always happy to talk more about this. But these are the kind of things we just wanted to expose you to.
Well, and doesn't this all make sense now, Catherine? He's a phenomenal guy, and his ability to analyze these things and process like no other. I'm always learning from Ike, and I love it, and vice versa. We've got a unique skill set between the two of us, but again, it comes down to some of that might have made sense and some of it didn't, and that's okay. But if there's anything that intrigues you about any of those different commercial investment strategies or classes or property types, we really encourage anybody and everybody to talk to us about it, because there's no shame in not understanding all of the different things. I'm going to be honest, I didn't understand everything I just spoke about, and I love that. But I want to learn more. So if anybody just wants to learn more, and we welcome the opportunity to discuss it more. But want to touch back on the fact that we do have investors that are willing to pool the resources together, whether it's to buy a bigger property or even investing can be lonely and isolating. And if you have somebody else that's doing it with you, that you can, when things are a little tough, even just mentally tough, it creates more bandwidth when you do it with a partner. So we can partner you up with people that are like-minded, have the same temperament or stomach for different types of properties and assets. And so that's really what we want to do. We want to be a matchmaker on that side, as well as finding the right investment strategy. But that being said, anybody have any questions? I know it was a lot of information, and I really appreciate you guys staying along for the ride. But if you have any questions, we're happy to answer them now or off the meeting.
Ashley, I would love, and Ike, I would love for y'all to provide a link so that we can send this out, because I know
Sure.
that the information that has been shared through this video is incredible. And you know, having a real estate background, I recognize a lot of what was discussed. It's still very familiar to me, but the idea that someone could have an opportunity to jump into a not a personal investment, but a group investment is a great idea. You know, for anyone that does happen to have the cash available to, but maybe not want to take on the full scope of liability,
Yeah.
where it's a shared thing. That's a really interesting concept. And so I would think that there are people out there that would be interested in learning more about that and how that works. So kudos to you for even bringing that up.
Yeah, no, absolutely. So this is recorded, and I'll send that over to you. And then this is our, we'll also send out the presentation that we did, because on this contact slide, everything has a hyperlink in it. So you can check us out on Facebook, Instagram, or YouTube. We do a lot of funny residential tips and videos on YouTube. So definitely look at that. And that's the thing, without sounding super corny, we call ourselves the Nest, RedBranch Realty. So, you know, we love to learn, and we love to bring more people into our nest and be able to go out there and create generational wealth for themselves and their families. And that's super important. So we're not just doing it to make an extra buck, because there's other options out there with probably a lot less headache and moving parts to do so. But there's something so amazing to either find somebody that buys their first home that their family gets to lay their heads in, or somebody that is able to create a different income stream. So when a recession hits or something else happens in a life stage, that they're protected. And that they're not over leveraged. And so now more than any time, we are digging our heels in, and we'll do everything we can to help anyone and everyone. There's enough money to be made. There's enough real estate, no matter what anybody tells you, to be purchased. So we're not scared to share our thoughts and our feelings and anything we can to provide insight. So we appreciate you letting us do this. Ike, anything else? Want to sign off and say goodbye?
Yeah, absolutely. And, you know, I think you're absolutely right, Ashley. I do end up sometimes, you know, one of the things Ashley warned me before this webinar was talk simple. So I've tried to do that. I've tried to do that, but I may not have been fully successful. So if there is more you want to learn, I'm always happy to talk more. If you want to just, you know, call Ashley and she can loop me in, and we can really discuss, and I'm happy to educate as much as possible. And that's really the starting point.
Awesome. Well, great. Well, I appreciate it. Thank you so much, Catherine.
Well, thank you both. I think that the word for the day is diversify in your investments. You know, that's really important right now, especially like you said, Ike, for those that are, you know, approaching their retirement years, and they're looking at their investment portfolio and wondering how now what. Right. for those of us that are not near retirement age, maybe we need to take a second look at what we're doing and diversify. So that was an eye-opener for me. So anyway, I appreciate you taking the time out of your day to help us with this. So thank you both so much for for all of your advice and your commitment to the real estate community.
Well, you're very welcome. And the last thing, and we'll sign off after this, is not only do we want to be a matchmaker service to find the right strategy, but we are also going to provide turnkey concierge service from start to finish. And the finish isn't when you close on the property. In fact, we've got the construction resources, the management teams, everything and such. So you can still be actively involved, but we can take all the headache out of the daily tasks from you as well. So I think that's why a lot of people end up going away from it. But at the same time, we can provide those tools and resources for everybody going forward. So, so that's that. Everybody enjoy the rest of your day as much as you can. Enjoy your homes, and I hope to see everyone's face in the near future. And of course, we're getting updates on the PPP lending as that's popping up on the screen, very timely. So, but have a great rest of the day, and we appreciate you guys.
Thank you.
Bye.
Thank you very much.